Now that we've learned about risk and reward, the next discipline that we need to learn about is the risk per trade. You know, everybody agrees you do not want to risk everything on one trade. If you do risk everything on one trade, it is trading suicide, and everybody agrees on that one fact. So, you know, what we need to do is we need to learn how we can pare that down. The less you risk, think about it this way, the less you risk, the longer you can play the game. The less you risk per trade, the higher your odds are that with a good risk and reward ratio, the higher your odds are that you can build up your account and stay in the game for a long time. So the question that we have to ask is, how much should we risk on any one given trade? Well, 5% is kind of an amount that on a high end is probably about the most you would want to risk on a trade. So let's think about it this way. If you have a $10,000 account, 5% of that would be $500. Now, it may take more capital than $500 to get into a trade, but if you've got a $10,000 account and your drawdown, that is where you enter and your stop, that drawdown is $500, that would be 5% of your account. So with a $10,000 account, $500 would be 5%. With a $1,000 account, it would only be $50. So there's a difference in what kind of trades you could get into if you only had a $1,000 account versus a $10,000. And of course, if you had a $100,000 account, 5% would be $5,000. So 5% of whatever your account balance is, that would be the maximum drawdown per trade. Now, if you want to really increase your odds, we can lower that to 1 or 2%. 1 or 2% of your account per trade is going to keep you in the game for a long time. And really, professional money managers who have a lot of money to work with, 1 or 2% is kind of the target that they tend to lean towards on a per trade risk. Now, I do understand if you're trading a $4,000 account, for example, you may just not have enough capital to get in there and only risk 1% on a trade. You may not be able to get into the trades you want to. So with the smaller your account, kind of the higher the risk is that you're going to have to take, at least to some degree here, but don't let it go more than 5%. 5% I'm okay with. 15, 20%, not okay with. So even with a small percentage or a small account, use a percentage that you can manage and you can stay in the game. And then of course, the larger your account, then the more capital you have to risk and still stay within that percentage of risk range. For trades that maybe you're less certain about, maybe a 0.5%, my general feeling on this is just don't trade them. If you're less certain about the trades, especially if you have a small account, don't trade it. The smaller your account, the more vigilant you have to be. So if you only have a $5,000 account, you've really got to guard that. Wait for the ideal trade setups only. Get into the trades that you really believe in the most and limit your risk per trade. Say I've got a $5,000 account. The most drawdown I can get on this is $250, so that's the most risk I'm willing to take. If you had a $5,000 account, maybe you buy a $5 option, which would cost you $500, but maybe your stop is at 50%. That would be a 5% of that overall. So 5% of your overall is the most drawdown that you want on your account size. Let's kind of do some math here, and let me show you what this turns into if we talk about risk per trade. Realize the game here that we're trading is a game of odds. It's really a game of statistics. It's kind of the law of averages. In baseball, somebody who hits every time they get up, they got a 1,000 batting average. That's not reality. In the real world, a guy who's hitting 25% or 30% is going to have a 250, 300% batting average there. And those people are going to make $4 or $5 million a year. So you don't have to have 1,000 to be successful. In the law of averages, what we're doing is we're taking over the big picture here, and we're saying over time, this is all going to work out for us. So in the game of trading, we've already looked at the risk reward. If we manage our risk and we say we're only going to risk $1 for every $2 we make, well, now let's go a step further. We say we know at least half of those trades we're going to lose money on. So let's average that out. How long can I stay in the game? And if we've got a $10,000 account, if you risk 5%, that's $500 per trade, that will leave you in the game for 20 trades. And so you can do the math there. You could actually be wrong for a lot of trades in a row, and with a good 2-to-1 reward to risk ratio, over the course of 20 trades, you're going to continue to build your account and you'll be able to stay in the game. If you risk only 2%, On a $10,000 account, that'd be $200. Well, you'll have 50 chances to go broke. So I think that you're going to have a good opportunity here. The truth is, if you go back to back, you lose 10 trades back to back to back, you need to stop trading. Do not risk everything. Don't go for the full 20. Don't go for the full 50 chances that you've got. You know, after 8 or 10, if you lose on all those back to back, stop trading. Go back through the trader conditioning process. Figure out where you're off, because you should not be losing 80 or 90% of your trades. You just shouldn't be doing that. Out of any given 10 trades, you really should be consistently hitting 40 or 50, 60%, to be completely honest about that. If you did happen to have 10 trades back to back and you just couldn't figure out what you were doing wrong, the odds are the next 10 are going to be all winning trades. It's kind of that law of averages, generally speaking. So just think about that. The law of averages over time, if you've done your trader conditioning, you've got your systems down, you've got your techniques down, now you're just putting the law of averages to work for you. If you only risk 1% of your account, obviously you're going to have 100 chances to go broke. Now there's another way we can manage this, and this is a little technique that I like, and one that I frankly think everybody should adopt. And that is a way to increase your plays without going broke. And what we're going to do here is let's say we take a $10,000 account and you got a 5% risk. So on trade 1, we lose. Now our account value is only $9,500 because we lost 5% of our account. Well, now our risk capital is going to go down as well. We're going to scale it. And so the new risk capital is only $475. So if on the second trade we lose again, our account is now down to $9,025. Our new risk capital is only $451. And as the account goes smaller and smaller, so does our account value that we can risk, or the percentage that we can risk. If you just keep the same percentage, if you common size it, you say we've got $10,000, I can risk $500 on 20 trades, you got 20 trades and that's all you've got. If you scale it down like this, you can actually stay in this game for a really, really long time, and you can increase those substantially. Now, there does come a point when, eventually, if you lost enough trades back to back, you'd only have $1,000 left, and there's just not much capital to work with there. But you can still stay in the game for a long time using this system, and I think everybody should adopt it. It really will keep you in the game for a really long time. So that's what I'm talking about when I talk about risk per trade. Per trade, how much are you risking of your overall account? And the magic number that I say don't go above is 5%. If you stay within that 5% range, you can stay in this game for a long time. Increase your risk and reward. Be consistent with managing your risk per trade. Now we've got 2 disciplines that are really going to keep you in this game and winning.